In this video, traders, we're going to look at the Wolf Wave trading strategy. Stay tuned. Hey traders and investors, a very warm welcome to you. If you're a subscriber, thank you for your support. If you're new to the channel, consider subscribing for more videos from me and others on the channel. Okay, so Wolf Wave. What is the Wolf Wave? Let's have a look at it. More importantly, let's have a look at a trading strategy we can use from it. All right, so Wolf Wave trading strategy. This is how the Wolf Wave is formed. Let's just put these, number them 1, 2, 3, 4, 5. Number one, you have a scenario where price has moved up. It's now forming an up sloping channel. So you've got a trend line, parallel trend line. You've got 1, 2, 3, 4, 5. So what have you got to what are the criteria you've got to have for this Wolf Wave to set up? So 3 and 4 must stay in 1 and 2. What does that mean? So basically the lines formed by 1, 3, 2 and 4, the trend lines that you draw must be, it must keep everything price intact. Now, are you okay having a few ticks over? Yes, you are. We're not going to mean exactly, but generally price is going to stay within. So if you draw a parallel line between 1 and 3, and you draw a line between 1 and 3, and you draw a parallel line between 2 and 4, based on 1 and 3, that should contain price. And ideally, you should get those touches there, and there. So 1 to 2 should equal 3 to 4. So you've got as much symmetry as possible. This pattern's all about symmetry. It's all about symmetry in price difference and movements. It's also symmetry with regular time between the waves. What you don't want is you don't want something that's taking ages for the next wave to begin. You want the drive up, the pullback, the new high, the fresh high comes in with 0.3. That angle is going to have to be pretty similar to the angle of the drive up. Then the pullback again, the angle of the pullback or the urgency of the pullback or the kind of stuff that builds the angle of the chart is going to be very similar to 3 and 4 as it is to 1 and 2. Right, so we're kind of making that a little bit more complicated than it is, but visually, when we look at it, you can see what we're actually looking for here. The drive, the tag, the drive, the tag. Okay, now, how it sets up. 5 has to break out of the upper trend line built by 1 and 3. So as you are drawing this, you're extrapolating that trend line out, as we've done here. Price wouldn't be there yet for you. We've just done this for illustration purposes. So 1 to 3, you'd extrapolate that out. As price breaks through, that's fine, that's normally a traditional breakout, but if price now starts to turn back into the channel that is formed by 1 to 3, by 2 to 4, now we're looking to take a trade. We're looking to take a short trade into this. This is bearish, this pattern, and this one's bullish. Okay, now it's counterintuitive because normally that would be a bullish kind of flag. And if you broke out to the high side, of course, you know, if it carries on to the high side, the key with this one is that its supply demand has shifted, but then it's gone, no, you know what? We don't want to go to new highs. We've gone to new highs once, twice, and now we're rejecting. And you use this to extrapolate the target. This is the point in it. So 5 has exceeded the trend line, and what your target now becomes related to how these have been structured. So your target is 1 to 4 equals 6. Sounds silly, but look, this is what we do. We draw a line from, and let's stick with purple, so we've got the same kind of thing. We draw a line now from position 1 through position 4, extrapolate that out. That then here becomes our target, our short target. So very easy to structure the trade. This is one of the good things about this setup is that, hey, as the price comes through, our stop is most likely going to be above that high. Makes perfect sense, right? If this thesis is correct and supply demand has shifted, that's a good place as any to put your stop. You get your trigger when you come back through there. If the price goes on and on, there's no entry. You don't have to worry about getting in the trade, right? If it breaks off and rips off to new highs, whatever. If it starts to come back, breaks back through, there's your short entry there, there's your stop, drives through, and your target is the extrapolation of 1 to 4 nodes down here. Very simple, very structured trade. If we're looking from a bullish perspective, same kind of thing, guys. We've come down, price has come down. Let's extend that out a little bit so we can see where that's potentially come from. Price has come down, it's forming that parallel channel. 1, 2, 3, 4, 5 is the breakout to the downside. We then push back up. And how do we get our target again? We extend the target from 1 to 4. So we've got our line that goes here from 1 to 4. Extrapolate that through, however far that is. Great. Now, when price hits that, That's our target. It only happens to me, but that's our target there. So same kind of thing. There would be our long entry. There would be our stop. And then there's our take profit area right there. So interesting thing to look at. You need to be looking really eyeballing on the charts. You need to kind of see stuff that's gone on. It makes sense from a supply demand perspective. Have a look at that. See if there's any opportunities you can think to tweak this and adjust it for better conditions. Perhaps you can use it on different time frames. This is generally going to be done on a daily time frame, but maybe you can try it out on a 4 hour, see how it gets on, or maybe an hour. Maybe you think less than that's probably a little bit too tight. But anyway, that's the Wolf Wave trading strategy. Thumbs up for that kind of stuff. See you next one. Take care. Bye bye.